Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, on the back of a de-escalation of global powers trade tensions, Singapore recently reported an improvement in overall factory activity in May, but still remained in contraction. Just last week, data from the Singapore Institute of Purchasing and Materials Management had revealed that the City-States Purchasing Managers Index posted a reading of 49.7 last month. That's up 0.1 point from April. What does this suggest about the state of the economy? Now, we also turn our attention over to a new political landscape that is shaking things up in South Korea, where newly elected Lee Jae-myung is faced with the daunting task of reinvigorating its economy. What could this mean for its underperforming stock market? And can investors expect a similar boost in stock market rally like what was reflected in Japan's market? Let's find it all out with Pan Jingyi, the Economics Associate Director at S&P Global Market Intelligence. Good morning, Jingyi. How are you doing today?
Good morning, Dan. Thanks for having me, and good start to the week to everyone here.
Yep, such a pleasure to have you on with us this morning. Now, let's get started with Singapore's latest PMI numbers, which marked the second month of contraction after a 19-month expansion streak, where a reading above 50 indicates expansion. So, how are you reading Singapore's latest PMI data, and what does it suggest about the current state of the economy?
Well, thank you, Dan. So, as you just mentioned, the SIP-MM number only looks at the manufacturing picture, and that itself has actually shown further contraction. I think this comes across as a bit of a no surprise, particularly given the current trade climate where the tariffs itself is coming in to actually be pressuring. And I would say this is not just perhaps for Singapore, but if we look across the region as well with the S&P Global PMI numbers in ASEAN, you also do find that kind of slowdown picture surfacing at this point. April, we did have more of this front-loading of goods orders ahead of the planned tariffs, or I would say, higher than perhaps expected tariffs across the world in the US. And that itself seems to be actually hitting the markets a little bit more right now, with more of this front-loading sort of dissipating into May. For our whole economy number produced by us at S&P Global Market Intelligence, now that is still in actually expansion, so it's showing that Singapore GDP itself is expected to still remain in expansion territory. But I think the only key point I will really point out from this is that we actually saw pessimism coming back across Singaporean businesses, and that's really for the first time since February 2023. So it's really giving us a bit more of this pessimistic outlook, though hopefully we'll see the trade tensions ease a little bit more. I think that's going to be key here, Dan.
Certainly, and that's something that we will have to keep a close eye on as it continues to unfold. So how do you see the challenging trade outlook impacting various sectors of the market and investment decisions within at least the region here in Singapore?
Well, so I think at this point of time, the uncertainty does actually matter a lot, especially in terms of return expectation. I think a lot of people are perhaps invested in the US market. So we're going to actually release our S&P Investment Manager Index just tomorrow to get a latest insight into Money Manager, but their views on how the market returns. But just from what we've seen in April itself, I think the expectation is actually lower returns, particularly in the US market, but across the APAC region as well. I think there is more of this uncertainty as to how that's actually going to position. I think things are going to actually improve over time, however, so that's going to be, especially as we get a clearer picture over what tariff itself is going to mean for the second half. As of right now, I think for the Asian GDP, for example, we are actually predicting a bit more subdued growth in this year. Next year in 2026, things are expected to actually pick up, and that will actually also be reflected in the markets.
Yeah. Certainly, and based on your latest data, I'm seeing that the S&P Global Market Intelligence PMI surveys did indicate that global business activity expanded at an increased rate in May, but still the slowest or second slowest since late 2023, forecasting a 2.2% global GDP growth in 2025. That's down from 2.8% in 2024. So then what do you think are some of the key takeaways from this data, and how do you think this might influence investment decisions as we navigate the ever-evolving economic landscape?
Well, that's a good point to really unpack this then, because I think you just mentioned it's a rise on a global basis from the number that you're seeing. But if we were to look into the below the hood, there's quite a lot of divergences that we have seen in the economic expansion in May itself. So for one, that improvement is brought about by service sector, whereas the manufacturing sector actually returned into contraction. So from this perspective, you would think that the position will be a lot more slanted towards services at this point. And not just in terms of the sectoral differences, because I think what we also saw as well is that due to the slowdown in the manufacturing sector, that has actually hit emerging markets to a larger extent compared to developed markets. So if you look at the emerging market, they've actually underperformed developed economies from our PMI index for the first time this year. So that's also a divergence in where you want to position yourself. And last but not least, I think it's also in terms of how monetary policy will actually shift, because interestingly that we did see price pressure, our PMI prices index actually showing increase in terms of inflationary pressure, but it was very much concentrated in the US. So that could actually be consequential for how the Fed will actually position in the next 1 year altogether, particularly given higher prices, still robust situation, though front loading may be accounting for it. So that could actually mean higher for longer interest rates. So on the FX side of things, that's also where you need to assess how returns will be as well. So hopefully that gives you a picture. Services, developed markets, those are still performing a little bit better than their counterpart then.
Right. Wonderful. Thanks a lot for that breakdown, Jingyi. Certainly something to look at, and the fight for inflation continues. Let's now fly over to South Korea, where they've just announced their new president, Lee Jae-myung, and his election comes at a crucial timing where he faces the daunting task of inheriting a weak and fragile economy that's battered by domestic political turmoil, natural disasters, as well as U.S. tariffs. And for many out there, we will be watching out closely as to how he stimulates growth and restores business and consumer confidence. In fact, it seems like there's some optimism into it because the composite stock price index, KOSPI in short, has entered into a bull market on Lee's first day in office. So what do we understand about his leadership approach? And do you think that that would be enough to revive economic activity, especially against the backdrop of the U.S. trade's agenda, where Korea faces considerable downside risks?
Well, so then I think to give you the numbers first, that we're actually predicting a slower 0.9% growth in 2025, but improvements are actually expected into 2026 with this current new administration to 1.8%. Now, why is this so? We broadly see the current result from the latest election is one that's actually supportive of newly elected President Lee Jae-myung's policy agenda. It's expected to focus on welfare expansion, pro-labor reform, and also diplomatic engagement. So the frequency of large-scale protests, which we know has been a key pressure on the stock market itself, that's expected to actually dissipate in the next 12 months, and business confidence will likely be actually improving. Importantly, we see them focusing on more stimulus in this year to help reach that kind of growth target that we are expecting. And also, when you pointed out, the important aspect of this is trade negotiations. So between South Korea and the U.S. administration, we see them actually prioritizing this in the next coming months, and that is actually expected to help South Korea reach, alongside stable conditions, but also potential improvements as well in the electronic cycle. That's going to help reach numbers we talk about 0.9, 1.8 in the next year then.
All right. I guess patience is virtue after all. So it does seem like foreign and local investors are growing more optimistic as well that the new president's push for shareholder-friendly policies will likely deliver stronger returns. But we'll wait and see how this plays out in the next 1 year or so. Now, before I let you go, Jingyi, what are key macro events to watch out for the rest of this week?
So very quickly then, I think very importantly, the key most important number is the U.S. inflation reading that we're going to see. I mean, evidently there has been, last week with the jobs report, there has been some of this pressure as well from President Donald Trump to urge the central bank to actually cut rates. But, inflation, that's all that matters. And I think for right now, based on our S&P Global PMI number, we're seeing prices potentially being a little bit on the higher side. So we want to see how that actually unfolds in the middle of this week. But besides the U.S., we also have China's inflation and trade data out today on Monday, another important GDP data from the UK on Thursday as well. But I think, it's going to be one that's very much economic data focused. And in addition to, of course, we have some of these potential negotiations between US and China in the background.
Oh my goodness. Jingyi, that seems like a lot of economic data to digest. Well, thank you so much for at least listing down the key events that we should be keeping an eye out on. And thank you so much for joining us this morning.
Thank you.
All right, we've been in conversation with Pan Jingyi, the Economics Associate Director at S&P Global Market Intelligence. Continue to keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.